So it was a pretty
All right.
slow week. We did get that pullback when some more tariff news started coming out. It's not looking too good. Like having this failed bear market rally bounce this early on, didn't even manage to get up to Momo. That's not a good sign.
Yeah, obviously, like I think the biggest concern everyone is having right now is there's like this seesaw whipsaw reaction in the markets. Like, you have a bunch of people calling for a melt up or at least like some immense amount of immense return, right? Higher in risk. Then you have another crowd like crying for a recession or screaming for a recession.
Yeah, you
And
have the bond
quite
crowd, which is just waiting for the bond trade, which we're kind of in that camp, but I think I think the bond trade's not coming anymore. It's not looking good either.
honestly, man, like the bonds had me hyped about a month ago. Um, and I think a lot of people were, to be honest with you, like the bond trade was in a position where bonds rallied quite a bit off the lows, right? Like come into Trump's walking into the White House, yields are just falling, bonds are ripping. Administration's really poking at rates every time they can on the internet, on the headlines and video coverage are always talking about rates. Trump's State of the Union talking about rates, right? So it was a big highlight on interest rates, and sure enough, I mean they were moving up, and pretty much since the first day of March, they've drifted lower. Pretty much since the first close of March, they've been drifting lower, and I think like what's happened is you run into this situation, right? So administration has everyone all bulled up on bonds. This idea that like the bond market comes first, not the stock market, right? The idea that look, we have this maturity wall coming up. We need to refinance all this debt. We need lower rates. And granted, 50% of the deficit, right, of the excess money, basically 50% of the money the government has to borrow every year is to pay interest. So there's this idea that like if you can cut the borrowing costs, you can cut a part of the deficit without actually having to cut major um, other major sectors of spending, right? The problem is that we run into this position where bond yields fell on this administration's more restrictive tone, and we aren't quite facing like a labor market acceleration yet. It's still early in the administration. We're only a couple months in, things can change, but labor market's not looking too terrible at the moment. Growth got hit, but it doesn't look like we're going to be facing a negative GDP print for the Q1 of 2025. And bonds kind of overreacted to the downside a little bit. And now that like, the tariffs are coming in, and yes, tariffs are short term, they have these short term inflation shocks, right? So if you look at like think about like a just today, BMW and Ferrari both came out and said they're gonna have to raise prices on their cars. That because they're importing, overseas their auto manufacturers. Now, the the key here is like the prices are going up in the short term because of tariffs, but Ferrari and BMW aren't going to repetitively hike these prices every single year, right? So they're going to lift the prices short term to offset the tariff costs, but they're not going to continue to hike prices at that like linear level going on a yearly basis. So you have this short term inflationary shock, which is mostly transitory. I
Yeah.
know that's a word
Well,
that everyone hates, but
it's a lot different than the inflation that we had before. Like there's a difference between inflation that's induced by helicopter money and the general population having a lot more money causing inflation versus this kind of inflation where growth isn't as strong as it used to be during the previous inflation wave that we had, and now this is added short-term inflation which puts further pressure on the consumer, which I think is going to affect growth even more.
yeah, look, at the end of the day, right? Inflation is primarily driven by money creation, right? You can't inflate your economy away um, without increasing the money supply or access to capital. It just doesn't work that way. So tariffs are going to be a short-term price shock as you basically shift the supply and demand curve. But you're not essentially creating more money in the system. What's going to happen is there's going to be a demand pull somewhere else, which is why the market is which is why tariffs are negative for growth, right? And the degree at which they're negative to growth, we're going to have to find that out. But I have a feeling that you're going to see this initial shock of inflation, but then a persistent growth drag. And I've been very vocal about this since I think December or something of that time frame now going on 4 months, where we're pretty much very, very against the idea of an acceleration in inflation. If anything, it just slows the disinflation curve that we've been seeing that the Fed has been happy and pleased about. It slows it down. We saw that a couple weeks ago when Powell acknowledged that there's a lot of uncertainty around inflation given the tariff news, which makes sense. And I really think, like, if you look at it from a perspective of this, that like those negative growth effects are very hard to quantify, which is why the market is trading the way it's doing. It doesn't know how. Like, just remember, we have Atlanta Fed GDP nowcast was down at like nearly -2%, -1.5%. Obviously, it's been adjusted higher due to the distortion from gold. And then you have New York Fed at like 2.6 or 2 points, something like this, 2.7% in that ball, in the high twos. So there is this dispersion of growth forecasts. Growth itself, the estimates have come down from later last year and very early this year on what Q1 of this year would look like. So the estimates and the expectations have already taken a hit. And that's been our prime that's been the prime driver of this slowdown we've been calling for. And I don't want to sit here and say the slowdown is over, but I want to emphasize that the slowdown is not a recession. So just because those slowdown drivers have hit the market and the fears are there, right? And obviously fears are very linear. Stocks are down, so people are scared. So people are thinking, okay, what happens if it gets worse? That's how this works, right? Until stocks recover. And in this environment where there's a higher level of uncertainty, bonds should be rolling over, but they're not. And that's telling me that like the market is gyrating more around a slowdown than a recession, because bonds would be well under, like the 10-year would be under 4%, well under 4% if you're worried about a recession. And I think that the prime driver for this is the resilience in labor. And like the economic surprises have been bad, but we haven't seen the crack in labor. And labor, again, is a lagging indicator, right? Things affect labor usually at the end, but the market is looking at it like we're in a slowdown and not a recession. And I think that's probably why yields are starting to climb again. And I think that, like, on top of all this, the market is kind of at this point where we were told a bunch of spending cuts were coming, and a lot of these Trump spending cuts are being caught up in court. No one really has an idea on what the deficit is looking like at the moment. I mean, obviously it's going to be negative, right? It's -5, -6%, something like this. But like, no one has the understanding of the direction of the deficit. Are the Doge cuts effective? Have they done enough in terms of cutting? And no one's able to figure this out, at least not yet. They will, and then we will understand this in the next couple of months. But um, Trump trying to pass tax cuts and all these other things, again, not deficit friendly, when a lot of the actions that Doge has been indicating that they are taking are being held up in court. So it's like all your spending cuts are being caught up, but you still want to pass tax cuts, and like no one really understands where
Yeah.
that deficit value is going.
And so the bond market is basically saying like it's very hard to get a recession when you're running this kind of deficit.
Right. That's another thing. Like, you're running a 6% deficit. Growth is slowing. How much is it really going to slow before you like it just you get stuck in a slowdown and it reaccelerates as the stimulus is still pouring into the economy.
Yeah. Well,
And
so
I and the
what do you think is going to happen if yields do hit that Trump ceiling?
I put the Trump ceiling on the chart as like a more of a line in the sand where like shit starts getting interesting, right? Like at this point, like I feel like things start getting spicy. I don't even know if yields get up there, but I think that there's the ability for us to shift between this fiscal floor of 4.12 and 4.75. We're slowly grinding higher now. I think that, like, at 4.5 on the 10-year, you're already going to see the administration out talking this down, right? Now, again, I want to preface it like I'm not this 4.75 is not the target, but if the administration can't deliver what they preached in the first couple months of the administration in terms of spending cuts and like more of a fiscal rebalance, the bond market is at the position where like there's no other reason why rates shouldn't eventually trade back up to where they were in January, right? Because if fiscal is not changing, growth's taking a hit quickly because of tariffs, and probably growth will suffer a bit more as tariffs, I think, will weigh more on growth than they do on inflation. But ultimately, like, there's no reason why the 10-year should remain like rebase lower, right? What's changed with like the overall outlook on disinflation? It's probably going to slow, so therefore rates are going to probably stay up a little bit, right? And growth will probably normalize and potentially even rebound at some point if this keeps going the way it's going. Like, unless we start seeing some massive shifts in um in the forecasted path of the deficit and government stimulus, and or maybe the Fed just really takes out all the like we go to a situation where there's no cuts priced in out to like 26, right? Like here's an interesting chart. Let's take a look at this. Look at this chart. So here we have the SOFR contract for December of 26. So think of this is where the market is expecting or discounting rates to be on average through a 3-month period ending December 26, right? 2026. So as you can see here, the market's been gyrating between this range of, a little over 2.5% and a little below or roughly 4.5% in terms of expected rates. Because remember, you're taking 100 minus the SOFR contract. That's going to give you the implied or expected rate of that at that point. So if you look at this, like we had this complete gyration from when the Fed first started cutting rates and everyone was like, oh, or implied that they were done hiking and the cuts were coming. Everyone got juiced on this idea that, okay, like rate cuts are coming, but like the economy didn't slow down. Rebound. Then you had this rebound on this whole like Middle East war inflation thing where, we were talking about Israel, Hamas, all that stuff, right? So that pushed yields up on the long end and pushed the probability of rate cuts out. It pushed rates up, right? And then we had this labor scare at the middle and end of last year when the unemployment rate started like rapidly ticking up. Rate cuts got priced, and we were actually long bonds for some point over here. And then no recession came again. Boom, gonged. And this acceleration down all the way to the prior lows was primarily driven by this idea that, we're going to have a Trump economic boom. Like the Fed's not going to need to really cut interest rates, or they're essentially not going to need to ease because the economy is so strong. And that got reversed in the last couple of last month or so here, literally last like 30, 45 days, on the preface that these tariffs are really going to slow down the economy. But we're not really seeing the rate expectations down to where we were in summer, right? This sort of like this the Fed curve is only at like 3.5-ish% by 2026, implying that by the end of 2026, which is a little over, well, quite over a year from now, year and a half from now, right? A little over a year and a half. The Fed is only going to pretty much enact something of four cuts, 3 to 4 cuts. So that's where we are right now. We were much tighter than that at the beginning of the year. But to go back to what you were saying, if the Fed can't, if the administration can't fix that deficit, then there's a high probability that we could gyrate back down to this idea that the Fed really is at neutral policy, and like them cutting will only ignite inflation until, disinflation has really taken full control and brought inflation back down below the Fed's barrier or close to it at 2%. So
Yeah.
I think that's what we're really like looking at right now in the market.
Yeah, like maybe this is the neutral rate. That's where we're at. And growth and inflation are just finally balancing because growth is down, but it's not terrible. It's still positive growth.
Yeah, yeah. I mean, like definitely a slowdown, right? Like I think the slowdown call
It's
has been magnificent so
yeah,
far, but
it's a
that doesn't mean a
slowdown
recession.
from it's a slowdown from what we had. We had insane growth. Like going from that to regular 1 to 2% GDP growth a year.
That's like not the word. Like yeah, like you said, yeah, 1%, a 2.5 to 1% slides a slowdown. It probably shocks the market, but it's not necessarily a recession. So
Yeah.
like that initial shock, market gets spooked, and then it consolidates, and then we have the rebound. Like I think the big driver that we always go back to the charts is like the price is going to be key here, especially like on risk assets like the Nasdaq. We're in a slowdown. We don't really marry a recession trade or this idea of having a recession. Could one form? Obviously, but it's never the base case. Um, because there is a lot of uncertainty around these tariffs. We don't really know how they're going to impact the market in the next couple of months. It looks to be shallow, but you never really know. The market, on the other hand, is back to bearish trend. So it's very simple from a structured perspective in the market, like on risk assets. Like as long as QQQ is below 500, 503, bearish trend's going to persist. As long as the bearish trend persists, equities, risk assets, stocks in this case are pretty unfavorable. Meaning like the risk of chop is just too high. Could you be buying down? Like, could you buy the Qs at 480, 481, and they just do a lot of chopping between 515 and 495 and just go sideways? Is that possible? Yeah, and it is. Something like that is possible. But like we don't want to get burned up and chewed up in volatility drag when we size up with leverage. So for us, while there might be some upside here on the fact that this is just a slowdown and risk assets could grind out of this trend and go back to bullish trend, and we could see risk on at the later half of this year, right? The risk is that like you get chopped up in the meantime, and it's just not worth the reward at the moment for us. So we're just sidelined on risk, and until the trend can flip, equities are pretty unfavorable. And obviously, same goes for Bitcoin. Like nice progress here. Like if you would have bought like the 80K break and fail, whatever it was back here at the middle of March earlier this month, nice gain so far. But like as long as this bearish trend, and if we get back below mid vamp, like nothing's to say that we can't revisit those lows.
Yeah.
And we could see, this is the thing, being above mid vamp, which actually Bitcoin's been holding up better than the Nasdaq. Being above mid vamp kind of gives me some confidence that maybe things could start to be shaping up. Because remember, every bottom and every bearish trend requires price to proceed to break and hold above mid vamp. Like just like go look back in time wherever you go. Like any type of like bear market low, right? Price has to get back above and hold above mid vamp to call the end of it, no matter where. This is like the last leg, the last sign before you go back and rise to Momo and then potentially flip the trend. The problem is like as you could see here, like there's a lot of whipsaw action. So this is good early indication, but not a sign of a trend shift. And this is something I think you got to pay attention to, right? Like, okay, Bitcoin's holding up well so far, but we're recording this at 7:24 p.m. on March 27th on Thursday. By 7:24 a.m. March 28th, Friday, Bitcoin could be down 2% from here, right? This is how Bitcoin works. So like it looks okay right now, but by tomorrow we might be back below mid vamp or we might be higher. So like there's a lot of uncertainty in a trend, right? We like to be long bullish trends and or risk on regimes. We're not looking at either of those at the moment. So there's just chop for us in Bitcoin. We
Yeah.
will never short Bitcoin and we'll never short the NASDAQ. So that's something to
Like
make note of. We're not going to short them.
worst case scenario with Bitcoin is we get long at 95K. That's worst case scenario. Best case scenario, Bitcoin drops another 20-30% from here and we buy it on the way up on a bullish trend flip, way lower
Yeah.
than where it is now.
Yeah. Now let's also understand like all other assets have, like if you look at the Nasdaq, we're back below. We've wiped out all the post-election gains. Bonds are actually looking like they have, I believe they wiped out. There are no post-election gains on bonds, I believe. They're they've pretty much they did erase most of the post-election losses, but they've since gone back into negative territory from when the election was held and Trump won in November. Like bonds are pretty much back down in the red. They're not bearish trend yet, but they're getting there. I think that like unless unless we can like have like a mega rally off the lows here, bonds likely face another bearish trend coming up, and that's just something that's going to be annoying. But like, given that we want to be long bonds, they looked great, um, but just not anymore. They
Yeah,
don't look as good as they did.
looking like healthcare is going to be the next play. Who knows? We have to see how growth goes from here, but XLV's bullish trend, all it takes is a slowdown regime, and we're into healthcare.
Yeah, utilities haven't been looking that great. I mean,
Yeah, no.
they're okay. They're okay, like, but they're not bullish trend, right? So like, obviously, healthcare is one of the only sectors right now that is holding bullish trend, which would be good, which is a good indication. And then maybe if we get some sort of relief in the negative growth impulses, right? Because a lot of people don't understand this about our models. It like they're not point for point. Like a negative 80% reading on growth impulses doesn't mean like depression. It just means that the growth reading, the impulses within the growth readings are very strong. And it essentially means that like you have something to worry about on the growth front, which we did in the last couple of weeks, the last month or two, growth got whacked a bit, right? Expectations. Now, it doesn't, again, that is, think of it like we are now going to see some relief probably in the growth impulses at some point if there is no recession formulating. And in that environment where there's some relief, it's not necessarily positive, but it's just not as bad. And that would open up the slowdown regime where things like defensives like utilities, healthcare, they have the opportunity to do well and provide some alpha. All right. Thank you guys so much for watching. If you have any questions, feel free to reach out to us on X at the Market Radar or go to our website at market-radar.com.